Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, September 4th. There is a flip side to a weak labor market. It helps curtail inflation. Second quarter unit labor costs fell 0.5%. This represents the labor cost to produce a unit of output. It means that while commodity prices have been creating some cost pressures on business to push consumer prices higher, labor costs have not. What has been happening is that companies are holding the line on employment or even cutting a bit, but output has not been declining. The economy has been growing at a decent pace, but businesses have been acting as if conditions are worse. As a result, productivity was up a sharp 4.3% for the second quarter. More output per person. That in turn leads to a lower unit cost of output, even with rising wages. The basic situation is clear. Productivity gains due to keeping payrolls in check are helping keep production costs down. As commodity prices ease, this means that both labor and commodity cost pressures on business output will be modest. This augurs very well for the inflation outlook. This morning's other economic release was more of the same for the soft labor market we alluded to earlier. Initial claims for the week ended August 30th jumped 15,000 to 444,000, which is higher than the consensus estimate of 420,000. The 4-week moving average slipped to 438,000 from 441,250. Continuing claims, meanwhile, rose slightly to 3.435 million from 3.429 million. This report is fairly consistent with recent claims reports that point to a soft labor market and won't do anything to excite the market ahead of Friday's August employment report, which is expected to show an 8th consecutive monthly decline in non-farm payrolls. I'm Pat O'Hare for Briefing.com. Thanks for listening.